Welcome to 5 to 50, Financial Strategies for Growing Companies, the podcast that gives business owners and entrepreneurs the tools to scale with confidence. I'm your host, Jeff Rudner. In every episode, we unpack proven strategies that optimize finances, improve cash flow, and leverage technology that all drive growth. So whether you're a founder, a CEO, or an advisor supporting businesses, you'll hear from proven experts and leaders sharing experiences and insights that you can use to help your company thrive. Let's build smarter, scale faster, and take our business to the next level. Hey everyone, I am super excited for this one. I have known our next guest for 25 years and have been in awe of how he's grown throughout his career, from starting in consulting to climbing the VC ladder. His latest adventure has been starting one of the preeminent emerging venture capital funds. Rick Zullo is an expert when it comes to startups, early stage investing, and he has a ton of share. We're all going to learn a lot today. So make sure you take a pen and paper out for this one. It's an honor to have him on the show. Without further ado, I'm excited to welcome Rick Zullo, founder and managing partner of Equal Ventures. Rick, welcome.
Thanks for having me, Jeff. And if we have extra time, we can dive into all the fun stories from high school.
That'll be for another podcast.
Okay.
I appreciate that.
That probably is more Barstool Sports, but
That's right. So Rick, let's start a few years back. Starting Equal Ventures. Did you always know that you were going to be an entrepreneur, or did you fall into it?
So I think part of me recognized that I needed to go this path of starting my own fund. It's something that I thought about in business school. It's something that I felt that was pretty necessary through the course of my early venture career. And I think there's really two reasons why. One, there's you want to find opportunity and you want to find ways to be as authentic to yourself as possible. But I think the other side of this is, as an outsider to this world, so many folks in venture capital, so many folks in the startup ecosystem, they're folks who grew up in the Bay, they went to Harvard or Stanford, they grew up within these firms. Maybe their dad was a banker at Morgan Stanley in the tech group, and that's how they got into this universe. It's a very guarded, ecosystem. And, someone who didn't grow up in that, I felt, candidly, I was just never going to be a fit within any of those big firms. I remember interviewing with, one of the major tier one venture funds before business school. And, they'd tell me things like, why would I get University of Richmond and Deloitte when I can get McKinsey and Princeton for the same price? And several years later, when I almost took a role, I was offered a role at one of those kind of big, venture funds, them asking me whether, these companies, vertical software companies that were transforming these $1 trillion industries, were, ever going to be able to move the needle on their fund. And fortunately, several of those companies have gone on to be multi-billion-dollar companies. But I felt like there was a need and opportunity to do things different than the rest of the other folks. And, the best way to satisfy that is, by putting it on yourself. So I think it's been an exciting journey over the last 6 years building Equal, and happy to dive in more on the hard parts of that. It's definitely not all been fun, but I can't imagine doing anything else at this point.
It's awesome. So you've worn a lot of hats throughout your career, from consulting, investing, advising. Why'd you stick with investing in early stage companies instead of operating?
This will probably seem, snark, but that great adage, those who can't do, coach. I for better or worse, I really regret not having been a true operator. I think by the time that I had been so dogged and stubborn about getting into private equity and then venture capital, I started to reflect on my career 10 years in and say, all right, all I've done is advise companies or invest in them over the course of the first 10 years of my career. I really haven't operated anything. And then, as you start looking at that and seeing the access to talent that you have, you just realize, okay, I can either be a very junior entry level operator. I can go and project the confidence and, that, VCs tend to do, and say that I know how to do things that I don't, but that's never been in my nature. I want to make sure that Charlie Munger, talks a lot of like, if you're going to say something, make sure that it's actually true. And I just never felt that about myself as an operator. That by the time that I really started to get that itch to be an operator, uh, it was so clear to me that there were people who were much more talented than I was to go execute on the ideas and visions, that we had. And the grand compromise here has been, incubation, where we do a tremendous amount of formation level for stuff for companies. Over the last 18 months, I've been involved in inception stage or formation stage or incubating, 5 companies, all with founders who built $1 billion companies before. And, that's how I kind of scratched that itch where I love being involved in the early stages. We love being the larger shareholder in those companies. I love being right alongside the founders, helping build those. But I recognize, what my limitations are. And that's really in helping them kind of get that idea off the ground, helping kind of bring initial product market fit and critical mass of customers, helping them kind of think about the capital formation. And, undoubtedly all those folks who built $1 billion, companies before, they're 1,000 times the operator that I will ever be. But I will always regret not having tried to build a company. And, now I'm too damn old, to go and start and do anything else. So,
Well, don't sell yourself short. I mean, you're building equal. And now talking through that, you've gone and you've advised and you've sat in board seats for billion-dollar companies. What surprised you most about being a small business owner when it comes to starting equal and keeping the lights on?
look, we are a small investment firm. We're a little over 250 million of capital under management. So a lot of people think our job VC is just exclusively to invest in companies. And the reality is when you're the CEO of that, you're not just a venture capitalist. You're someone who's thinking about all the nuance of confirm, yeah, we've got to go and raise capital. Only fortunately, that hasn't been, the most difficult task for us since, fund one. Fund one was incredibly difficult. Since then, we've been fortunate to have some incredible, LPs as partners who have been very supportive. But look, I have other people on my team that I want to make sure that they're progressing in their career. There's a bunch of compliance, financial admin. I spent more time with filling out filings and all those other things than most people would think as part of my job. When you think about how we invest in building our brand and how we think about investing in the infrastructure that we want as a firm, or investing in this office that we just moved into, a month or so ago. These are all things that, you have to make capital allocation decisions, not just with your investable capital, but with the management fees that you have to figure out, all right, our business is not to be in the management fee business. It is to go and find, companies that we invest in are, very small valuations and help them become very big, companies, and hopefully, reap the rewards of that, which, the investments that we're making in our infrastructure, in our people, in our brand, they are 10, 20-year investments. But, as you think of the time and capital required to do that, that takes an immense amount of my job. That I meet far fewer companies than most people think I would, and spend a tremendous amount of time with our people, thinking about the strategy of the firm, with our portfolio companies, with our LPs. That has become very much the dominant part of my job. And I love it. Like maybe it's that management consultant, in me that, thinking about the strategic direction of our companies and our firm and our people, ends up satisfying me a little bit more than if I were a banker just like chasing the next deal. The deal side of the business is actually probably like the least satisfying, aspect of what I do on a day-to-day basis.
Yeah, it's interesting how you can wear both hats and bring learnings from both to your portfolio companies, but also I'm sure you're applying learnings from them to grow an equal, right? You have customers in your LPs, you have revenue from management fees or other sources. You got to keep the lights on. You got to pay the bills. You got to pay payroll. You have to do your accounting.
Well, I think the talent side of it is where you see the most overlap of, kind of seeing, we're all in the investment business of investing in people. Like, the 5 last investments that I've done for a firm, there has been no product, there's been no revenue. it was backing someone with a vision that we aligned with someone that I had largely known for a long time and seen the arc of their career and, making it that on a team that, they're going to do something exceptional. That's the same thing that I'm doing here. We, not a single person on our team is an Ivy League undergrad. We're investing very, Ali on our team is a college dropout. He wears that as as a badge of honor on his chest that he's a couple credits shy, from his degree at University of Illinois. But he has 10 years of VC experience at this point. So the reality is, I think the investments that we make in our people and seeing the arc of their careers, ultimately, that's one of the biggest investments we can make. I have 5 people on our team. We have 15, 16 companies per fund. One of those is more concentrated than the other. So making the right investments in our team, and helping founders kind of make the right, decisions on the people that they're investing in those early days, getting the people side of the business. It's so make or break, and something that I definitely have more appreciation for, 10 years into, 12 years into, doing this than I did on day one.
So let's drill into that a little bit more. I think that's super interesting. And I think it's something that our listeners can learn a lot from. How do you approach analyzing talent and determining what the needs of the business are and how you can determine if a candidate can fit those needs?
Yeah. So I think, the reality is it's different things at different stages. And, the earliest stages, I think you really want to find people who personify grit. Do they have passion and perseverance for the task at hand? Are they willing to go the extra mile, or do you need to drag them kicking and screaming? And I think, those are folks that, are not necessarily individual contributors. They're not specialists. They are folks who will, be balls and muscle, jack of all trades. They'll do whatever it does to, keep things in business. Like, you'd be amazed. Like, I'm still the guy who waters the plants and takes out the trash here. So the reality is, finding those folks who, sometimes we call them, mechanics, because there are folks that find a way that if they see screws loose, on a rocket ship, they're just finding ways to go and tighten those bolts and make sure everything works. And I think having folks like that in the early days of a company, are incredibly impactful, because companies change so quickly, in that having those multi-purpose athletes is incredibly additive, to making sure that you can navigate the agility required, for that environment. As you become more mature as a company, let's say, you're Series A, Series B stage, you have product market fit, I think that's where it really becomes important to start bringing in more specialized expertise of folks who have done things before. That I think, you as a founder definitely want to learn a lot on the job. But the reality is there's so many lessons, best practices, especially if you're a first-time founder, that can be learned much more quickly from bringing in qualified experts. So someone who's been ahead of sales before, or someone who's ran marketing campaigns, or, you wouldn't want me being, building the product of, a company, because I have no engineering background whatsoever. So, why not go and bring incredible people in? And that's where you go from being like, the best guitar player to the best maestro. How can you bring those folks together to make sure that all of these instruments are humming in unison? And I think that's where, we see our best CEOs really, really scale up is, how do they put the ball in the hands of the people that they work with, and really find the right, folks that, are the best tuba player, the best trumpet player, the best, name the instrument from there, to make sure that they're making a resounding chorus. And I think that's actually the stage that transition, for most of the founders and CEOs that I see, is the most difficult part. They want to be on the field, they want to be selling, they want to be building, and making that transition can be tough. That's one of the things that I think myself as a VC, like, I love working with founders. I love, going out and finding the next new opportunity. But, I also need to position myself that I'm, putting the ball into other folks' hands, which is the reason why we've, subsequently, evolved our, operating model internally to have people who are specialists. We call them product owners, folks who spend 100% of their time, in a given sector to do all the research and be, qualified experts in those. And we have some generalists who are out, kind of, scouting and sourcing deals and developing relationships with founders from a more general point of view. And then, hopefully over time, I become a little bit more of a maestro, certainly have the gray hair for it. So
Just to clarify, you're saying product market fit is when you want to start bringing in those experts. Early stage, before product market fit, generalists can have the greatest return. Is that your approach?
Finding those all-purpose athletes, like keep your team extremely small until you have resounding product market fit. I think of cases where like product market fit wasn't definitive or it was market driven. There's certain categories like you can't lose, in crypto in 2021, or it feels like AI right now. Like that actually may be a false signal of product market fit. You can achieve traction without product market fit. But I think absent that today, really making sure you keep things very, very tight so you can learn the lessons, be as close to the customer, having that circular loop between customer feedback, bringing that to the product team bringing it to the customers, keeping that circle super, super small and tight in those early days of the company until you've achieved product market fit, I think is really, really important. And once you have that and it's feeling like the company's starting to like rip away from your hands, that's when you want to bring in really great specialists and transition those skills down of, hey, here's a bunch of customer relationships. Here's how we've done things the best. Take your own spin on it and take it to the next level. If you have to bring in experts earlier, it's usually a sign that, there's something wrong in your go-to-market and or product function that, that can be helpful, but I really would diagnose if that's the case. Is that a people issue, i.e. do you have the wrong people? Is it a product issue? Do you have the wrong product for the market? Or is it a customer market related issue? You're going after the wrong segment of the market to launch something. And it can be a people issue, but more often than not, it's a product and positioning issue.
Let's talk about the founder journey a little bit. And what are the most common surprises founders experience when scaling? What is that thread that you see often that takes founders aback?
I think the reality is it's going through the emotional highs and lows of sometimes they get way too high and sometimes they get way too low. And it's really hard if you haven't done it before to prepare yourself for that. And I think one of the best things as a board member you can do is kind of be that mediating force to bring everyone to center ground as much as you can. So if I see a company getting over its skis a little bit, yeah, I'm going to try to temper it because, that's where you can go and, raise capital at too high of a price and be, trapped under preference and a bunch of other things. I mean, you're seeing a tremendous amount of this in the market right now. Folks who raised at multi-billion-dollar valuations and the founders walked away with butt kiss. And it's because, they got lost in their exuberance and, they could only see the upside from there. And, VCs definitely fall victim to this. But you as a founder, you get a portfolio of one. Most VC firms get a portfolio of dozens of companies. So they are incentivized to have as much exuberance as possible. We run a much more concentrated portfolio. So any loss that we take like that is a pretty big one. So we want to align ourselves with the founders. If we feel like they're getting a little over their skis, kind of temper things back, have more realistic expectations, prudently manage risk to think about, the long-term story, not the short-term story. Same thing on the other side. If things are tough, like that's where you got to go and be like, a lot of VCs will become cheerleaders when companies are successful, but they're not there to help the companies when they're not. And I think, really finding the right people around the table is just so important. And look, there's certain, methodologies that folks have or, different segments of the Silicon Valley ecosystem that really just think, investors are capital, but, for better or worse, that's not our point of view. It's not the point of view of the founders that we work with, that really view that as a partnership because they've seen and been to the show of, man, these times can be really exciting and you can make really, dangerous mistakes when things are, seeming like they're going incredibly well. And other times where I've seen companies on the brink of death, come back and actually be really amazing outcomes, both for the founder as well as for the investors, that, other VCs would have just walked away or told the founder to shut things down. And, for better or worse, I think those are the times that, VCs really show their mettle. There are companies that we have that if they're struggling, like we're going to be the last ones to go down with the ship. So it's really hard for you as a founder to understand the volatility of that emotional journey. And I would just say, making sure you have folks that can help you ride those waves, is so important and so much more impactful than, the price you raise at or the, brand name and how many Twitter followers that, that folks have. So, never underestimate the people side of this business because small deviations can have dramatic impacts over the arc of a company.
I love that. So many people, so many entrepreneurs focus on the product or they focus on growth and revenue and numbers, but then they lose track of the fact that they need the right team to help execute. And it's a people. Every business, well, maybe not so much going forward, but businesses today at least rely so much on people and having the right people support you.
There's probably never a founder that I've worked with that didn't think their people were better than what they actually were. And, I think this is the reason why having, you know, experience around the table, whether it's on your board and your team, to like know what greatness looks like is so important. Where, I can think of even in some of our highest performing companies, some of our founders were extremely resistant to make changes in talent because they felt their people were exceptional and and there's so much loyalty, especially when someone's been there early, and more often than not that's a big mistake. That if you have the inclination that one of your people isn't great and you're starting to have concerns about that, chances are they should already been gone like 6 months ago. And, I think that's actually where we've seen some really tragic moments in our companies of, all right, we lost an entire year of momentum because we had the wrong head of sales or, hey, operations got out of whack because, we had a COO that, really didn't know what they were doing or brought in the wrong person. That, and some of these hires can be just immensely consequential. And I think that's the reason why, especially if you're a first time founder, incorporating feedback from your board, investors, or from, some of the more experienced folks on the team. That's one of the reasons why I love a great generalist, like coming into a company really early because, one of our portfolio companies, 3Flow, we brought on this woman, Cynthia Vasquez, that, we've known nearly 20 years. She's been an incredible operator and, she's been part of a bunch of great companies and, she came in very early and, helped build out a team of incredible people. And, I think that had, tremendous impact on that company, which at that point, she was the only person out of the first 15 people in the company that had ever worked at a startup. And now we have some really incredible people. It's, a company that has a tremendous amount of impact on the market, and is one of the highest performing companies in our portfolio. But certainly, so many lessons learned from bringing in a person like that very early. And we encourage founders to, if they don't have experience working at extremely high performing cultures, and that doesn't mean that they aren't exceptional. It just means bringing some other folks who have a lens to what that is, and there's a lot to learn from them.
Yeah, think about making sure everyone's at their highest and best use. From an allocation of time, resources, super important. When is the right time to pivot from move fast and break things mentality to building out SOPs and systems and processes for companies?
When you as a CEO can't name every single person in the company, like that's where like you really start needing some hardcore processes. Because the reality is when you're 30, 40 people and you can go and check in on everyone and you kind of have your finger in a little bit of everything at that point, that doesn't scale. And that's the reason why like you start needing the next layer of management, and the next layer of management to have continuity needs to start implementing best practices, implementing SOPs, and implementing processes. And I do kind of find that's when like you're at the point where you can't name the kids of everyone on your team or who their dog is or what their favorite TV show is, because that's at the point where you need to start to rely on institutional knowledge rather than your intuition and intimacy that you have with folks. Like we still, as a 6-person team, we have a ton of SOPs here at our firm, and it's not because of the lack of intimacy or whatever, but it's because productizing what we do helps us move faster. We've learned that over time. But the reality is if you're a founder and you're trying to move fast, like you just can't rely on, all right, I know Davey will have it figured out. And like, that doesn't really scale and you can't justify that to a comp committee, or if that's the case, like you start needing internal controls, to do these things, especially as you've probably at that point given up, control of your company and, want to make sure that you're, doing proper governance for, the board and building that to be a scalable company. Because even if Davey's great, there's going to need to be 200 Davies in the company by the time that you're, hitting a public company or, getting ready for like a very mature exit. And, that takes years to build, if it's going to hold everything together.
But even much smaller, just figuring out how to pay bills and how to get budget into the department heads, how they actually pay for spend and whatever they pay vendors. Those seem simple to talk about, but those are systems and processes that need to be built out way before you go public.
The thing about, those type of functions is that everything seems simple and then it finds a way to get very, very complicated. So, it's like all aspects of business. Like, they're best when they're as simple as possible. And, if you can find ways to make things simple, that's great. But the only way that you can do that is by finding ways to make sure that they're repeatable, that they are, aligned with best practices, internal controls, risk. Because, there's no way if you're just putting 100% trust in people, if you have thousands of people, something is going to go wrong. And, having audit trails processes and, the controls in place to show that you did whatever you could, or that there actually is fault at the individual level rather than at the entity level, all that stuff becomes incredibly important. So, look, it comes down to compensation systems too. Like you want to align incentives with outcomes. And, I am continually amazed at, as the learning curve that companies have to go through as they go through that of aligning outcomes to, income, and companies and setting up repeatable frameworks for that is usually one of the things that, companies adapt to the latest, opposed to just saying like, hey, I like this person and we're going to give them a raise. Like that's from a legal perspective, HR perspective, and finance perspective, like bad practice. And most people aren't thinking about those type of things like very early.
And so what are some frameworks that you've seen work in aligning those incentives and rewards?
I think it's different for every company. Look, there's tremendous amount of compensation data that you can get for people at different levels, but this is the reason why bringing in folks who have understanding of, and I've seen this across not one company or two companies, three company, but hopefully dozens, if not hundreds, is extremely important because setting up those compensation systems and saying, hey, this is a VP level versus director level. Okay. Like a lot of people want to give themselves title inflation. They want to think about like becoming a C-suite individual, especially with, I think there's a lot of that culturally, in the startup ecosystem, but, across the country right now in corporate America as well, that everyone wants to be, more senior all the time. And even if it's not, fully justified. So, getting those, titles right is extremely important to align with compensation. I think having third-party perspective in that, or people who can actually say this is director level, this is VP level, is extremely important. Then figuring out how that aligns to your corporate strategy, which I think some people are a fan of OKR, some people are not. I tend to be more of a fan of them than not. Every company's different, and the reality is seeing how the OKRs of different groups, really funnel together. How is marketing, sales, product, and customer success, and all these goals tying together for you to achieve what you think is necessary for the overall objective and vision and mission of the company, and then making sure it's aligned to it. Recognizing if you set up those type of goals and OKRs poorly, it is massively in the incentive for everyone to gamify them, and that can really screw you over as a company. So I think getting those systems right in terms of how you're compensating people, how you're thinking about setting up those bands, how you're thinking about aligning them to strategy, it all sounds very tedious, but at the end of the day, when you're approaching hundreds of people, making sure everyone is on the same sheet of music, that you are being the maestro and that people aren't playing a different song, is so incredibly important. And I am a big Charlie Munger believer that show me incentives and I'll show you the outcome. If you get the right compensation incentives in place, you get the right people in place, all of a sudden, all this stuff becomes really simple.
I agree. And being intentional about it early is super important because it might be easy to think, this doesn't matter. I'll give someone a director title or a VP title because we're early and, they're doing everything. We don't need to worry about it now. That thinking that can really come back and bite you when you're a much bigger company. So thinking about it from the get-go we find it super important and super helpful.
That's the reason why, Deloitte never promoted me, right? They wanted me to, have the fire to earn it a little bit more, so no, yeah, I do think, look, showing progression with people is important. I think, obviously you always want to pay your people more. Like, no one wants to have conversations with people where saying like, hey, you did not meet expectations, or, I'm going to pay you less than you want. And I generally believe you're far better off, paying above compensation, expected compensation than below. Because people who are disgruntled about their compensation, are never going to be, fully in it. That said, you definitely want to find what are the motivating factors for people, which is, I think about your compensation systems. This is where, thinking about total comp, making sure you have a lot of data about it, making sure it's lining into systems. Who are people who, we are better off aligning with equity? Who are people who are better off aligning with bonuses? Who are people who, require cash comp? You got to be really thoughtful about that because, product and engineering investments, there may not be as crystal clear OKRs, in the, year of as there are in something like sales or marketing. And, so thinking through how you're going to have this, and, incentives align, as well as meeting the needs of your people, which, you could have two people in very, very different income scenarios where some don't value the equity and only want cash comp. And that's not a bad thing. It's just, you need to go and figure out ways that you can align that. So this is where having compensation bands and having, the flexibility within those frameworks to say, how do we meet the needs of our people, while making sure that we're thinking about the total compensation and incentive alignments as a company, is just extremely, extremely important.
What are the common financial oversights you see founders, entrepreneurs, and growing companies make?
So one, I think like there's a whole aspect of fundraising that like people, make a ton of mistakes in this. And I think capital formation, especially as it's related to like not just equity, but debt, is something that I find most people make a lot of mistakes of, convertible notes stacking up on each other. And they don't realize like how little of a company that they own, or they give so much equity to their employees along the way that they don't realize that they've obliterated themselves on like their ESOP and put themselves in a really tough position, from that. Most people don't realize the downside of debt. They just think of it as free money and they end up, burning way more of it than they should have.
Define ESOP for us.
So employee stock option pool. So, I think, look, at the end of the day, like if you're a public company, stock-based compensation is something that like ends up being, part of your earnings report. Like it's not free to give away equity in your company. I think a lot of folks think that, when they look at their burn as an organization, they're just looking at the salaries and bonuses and the cash going out the door and not thinking about, the incremental equity that they're getting. So I think, look, on the talent side of the business, thinking through financing is extremely important. Knowing how you're going to use, your option pool at every single stage of the business is incredibly important. And knowing how that ultimately leads to the dilution of the business when you start thinking of equity debt, which I think, not everyone, I'll see plenty of founders come to us with cap tables that are a complete mess that we need to recap because there's convertible notes that have stacked up that, there's, employees that haven't been there for, 2-3 years that they gave the farm to because they didn't have, a lot of the right processes in place and they vested all their equity already. And, all that can be cleaned up, but most VCs are just not going to deal with that. They're just going to say, all right, like on to the next one. Like you made that mistake. It's a fatal mistake. And, they don't want to do the work, candidly. So I do think it's incredibly important to get the stuff. And look, there's so many, founders that actually have great companies, but, they raised in 2021 at a valuation that was, completely bonkers and, or they, ended up taking a lot of debt and spending more money than they thought. And, it puts those companies at a position where they can walk away with zero, having actually built something that's really fundamentally valuable, but not in a position to be fundable. I'd say the second side of this is like, I think every founder, especially when times are good, they spend more money than they should. I think like the amount of companies that I've seen like overspend on their real estate footprint, like take down massive office leases, sign, office leases that are too long, then plenty of them did that just before COVID. And then like, oh, now they're work from home or, whatever, that they don't think about lease liabilities or contract liabilities and some of these things that, ultimately like, look, when you hire someone, that's an additional contract that you have severance and everything else associated with it, that the liabilities extend beyond just the burn when you do that. So, I think, when you're adding to your burn, when you're adding to the OpEx of your company, you need to think about the long-term liabilities associated with that, which, reducing headcount in an organization is extremely painful. It's often more necessary than I think founders, give it credit to. But the reality is you are way better off just not hiring that person to begin with, or not taking on that lease, or not taking on, that additional CapEx that you have, just always trying to preserve as much agility, whether that's through contractors, whether it's through short-term lease structures, whether it's through other things that don't lock you in. You want that agility to be able to actually have the most prescient thought about where your operational cash is coming in and cash is going out. And I do find that so many people don't fully understand, the balance sheet considerations or the liability considerations that are associated with that. And it's really hurt some companies. It's really hard to undo some of those things once it's done.
Yeah, that's a great point. I think so many companies just focus on the P&L. What's my revenue? What's my net income? And never look at their balance sheet. And it's a overstep. Super important to start with the balance sheet, understand your capitalization, a plan and structure, and know your financial position. So great perspective there. Let's talk about exits. How do you know as an entrepreneur or founder when it's time to exit? Is it when Rick calls and says, hey, it's time to liquidate?
We're saying it's time to liquidate. It's probably too late, to be honest. So I think like the reality is like you as a company should always be having an ear to the market. But I do think one thing that is most important is when you feel that exuberance, that's when, you need to be considering the most. Like when your company is not working, that is exactly the time that you shouldn't sell. And that is the time where like figuring out how you position the company, to get it to a better point so that there is some exuberance and excitement around it. Look, if you want to go and sell to Constellation Roper or any of those, kind of aggregators, you can, but they're going to buy you at like 5-6 times revenue. And, compare that to in the venture ecosystem when most people were raising at 50 to 60 times revenue. And, now I hear absolutely insane things in this AI universe of, people regularly investing at, maybe 100 times revenue. You can see your revenue increase dramatically in a business and your valuation collapse. And, that's because there's different buyers and there's different levels of exuberance. So, I've seen folks turn down acquisition offers, that were early because they felt that they, were going to be something phenomenal and then walk away with nothing. And I do think like as a founder or investor, this is where risk management and thinking about portfolio management is important. I actually encourage many of our founders to take a little off the table, make sure that they can actually think more long-term oriented. We may or may not sell alongside them in some of those positions, when you're hitting, large valuations where we've already seen 30, 40, 50 times, on our, money, on that company. And I do think that's, thinking about how you can sell pieces of that. That's a conversation that you need to have with your investors. You need to have with your board. You need to think about your personal financial situation as it relates to the company and make sure you need to avoid conflicts of interest there. In the case of M&A, like, which we'll put that aside from IPO, like I'll let the bankers, opine on when it's time to go public. But M&A, like you always want it to be opportunistic. You should always be developing relationships with, those markets that are going to be the potential acquirers in that business. But you want to do it when you're coming from a point of strength and before it's obvious that like you've hit your plateau. And I do think, there are companies of ours that we've been like decidedly very coy about because we don't want the M&A universe, to come to us too early before we've hit a point where, all of a sudden they feel like, the incumbent is on their back foot. That's when they're going to make the buy. That's when, I'll say, we recently, started work with a company, and, there's $150 billion, incumbent in the space, that I'm very friendly with, the chief innovation officer, head of corp dev. And, when they told me, maybe 2 years ago, 3 years ago, hey, like, this is the spot that if I had to make like a very irrational buy in the next like 5 years, it would be like in this market. I was like, all right, we better go find a company there. So it's like, you always want an irrational buyer, not, I mean, if I have a company that's, we're selling at 5 times revenue, like, that is what it is. But, I'd rather, someone value the technology, the IP and everything else, and, give us 50 to 60.
Cool. So with that in mind, how should companies prepare for an exit? What are the things that they need to do from a operations and hygiene, financial hygiene?
One, like, always your book should be clean. Like, so, I think this is the reality, is like, if an M&A buyer is coming to you and like it takes 2 months for you to get actually like clean financials, clean economics, dashboards of like, your performance, like, deal's done. Like, time kills all deals. So the reality is like, we do the same thing with fundraising, that, we're preparing months in advance so that the process moves with extreme expedience. For an M&A process, you want it to be like, all right, hey, like, we're going to have this conversation, and then I'm going to give you 72 hours to make a decision. And, and if you give access to all that information, they can see, like, that's not only a sign of, okay, like, here's where the company is financially, but they've probably already come into that saying, this is a product that I want, this is a position that I want, this is a team that I like, I need to make sure that the numbers make sense. And, the reality is, what gets them out of that position is if the numbers are sloppy, that they're, they can't get access to documents that they need, that, all of that stuff takes, weeks to prepare. That ends up being a kind of canary in a coal mine of some of the organizational issues that they think of, man, it's going to be hard to integrate this asset. It's going to be a challenge to get these guys to adopt to our culture. It's going to be, maybe this isn't, as strong of a team or as well run of a company as I thought. Whereas when, say, hey, we're going to keep this tight. If you're interested, I'll give you access to all this stuff in the next 72 hours. Here it is. Just tell me exactly what you need. Here. And then, punch them in the face with being over prepared in those situations. And, that enables you to actually, control the timing on your end to say, all right, we're either doing this or not, but like, I don't need to sell to you. So the reality is, like, if you want to do this, like, you got to move fast. Otherwise, like, I'm going to go focus on eating your lunch out, like, out there, in the field.
Completely agree. So many people take having financials and diligence all tightened up, or documents all tightened up on a regular basis. But when someone's looking, it's like if you go to a house that doesn't have a roof on, there's something just by looking at it that's off.
Would you ever buy a house like that if you saw, like, you walked in and you're like, okay, like, the beds aren't made and, like, there's paint chips on the floor and all this, it's a sign that, like, people don't care. I mean, I don't know, maybe that's a distressed buyer that's going to come in there. There's a reason why, all those real estate agents are, hey, like, let's make the chocolate chip cookies and, let's, stage these houses. And you want to do the same thing so you can maximize the price. And hey, looks like this is our dream home. This is a dream organization. These guys do things better than the way that we do. Maybe they'll help fix our problems internally. And, that's the thing that gets people to say that I love this acquisition, rather than like, yeah, like, this thing can add another couple million of EBITDA to us. Like, let's give them a 10 times multiple.
All right. One more longer question before we get into rapid fire. What's one piece of advice you give to entrepreneurs and founders who might be thinking about raising capital? What should things that they should, pros and cons of it, and things they should look out for on the way?
Only raise capital if you feel that those investors and what you have is aligned to their expectation of outcomes. So, the reality is, like, we're swinging for big outcomes, and there are funds 10 times our size, 100 times our size. They're swinging for even bigger ones. That if you think that a $200 million outcome is what you're aiming for, you going to a $10 billion fund is perhaps the worst thing that you could do. Like, and yes, that may mean that, you're raising capital at a higher cost and you have to take more dilution and, or a lower valuation, but it will ensure that you have investors aligned for the outcome that you believe is most achievable for your business. And that's so incredibly important, because if you give up board control or if you have situations, early in my career, I had an outcome, that would have been fantastic for me and the founder. And, it didn't align to what some of the other investors wanted. That company subsequently didn't work out. The founder would have made tens of millions of dollars. We had other outcomes like, risk matching battery, where, in those cases, we raised less than $10 million for, those companies. We had investors who were, comfortable with a smaller scale outcome, on those. We sold each of those companies for 9 figures, one within the first year of investing, one, within 2 years of investing. In each case, the founders walked away with tens of millions of dollars and have subsequently gone and done other great things. The veterinary founders ended up starting Archer Aviation, which went public, and Figure, now the humanoid robotics company, and they've gone from having a 9-figure exit to having companies worth billions. Like Kabir at Risk Match, I spoke to him this morning actually. He's on his next company and he's been a prolific investor in a bunch of other things. So finding those investors that fit your profile, opposed to I won't name that other company that didn't work out. It's a shame because that founder was brilliant and talented. And I can think of just a completely different arc for his life. Had we sold the company for $125, $150 million instead of it not working out, like he could be at a very, very different place. And, I think you got to really make sure you're getting in bed with the right people.
I love that. All right. Just a couple rapid fire questions, 1 or 2 words. To take us out. What is one technology trend that you're super excited about right now?
AI is a very in vogue thing to talk about. I think what I've believed and what we started our fun on was the belief that the universe wasn't just going to be SaaS. It was going to be the ability for people who were, kind of everyday people, that, the non-technologists, folks who understand their industries, on the ability to deploy technology across them. And it's just absolutely insane the amount of traction and what we're seeing in some of these folks who are able to leverage kind of relatively off the shelf technology tools and have a absolutely disruptive impact on, the operations of an industry. So, we just funded a company that does agentic, services for the insurance industry. Look, 20% of labor in the insurance industry is done through BPOs and so forth. It's all gone to, consulting firms or, TPAs and so forth. And it is just absolutely mind-boggling to see what the capability of AI is to automate some of those workflows of the tasks that humans really don't want to be doing anyway, but undoubtedly are filling off an entire room of people or entire floor of people at some of these large insurance carriers. So I think the really exciting thing right now, and I know this isn't two words, but that I can't stop talking, is the fact that we don't need to be stapled just to SaaS. It's the fact that now anything can really be a technology company. We have a food company that uses, AI. So, I think figuring that out and saying, hey, this is about building great businesses, not just building a software business, that should hopefully make, the venture ecosystem a little bit, opener and a little bit more exciting for everyone else around the table.
What's a book or resource you often recommend to founders?
Competition Demystified by Bruce Greenwald, best business book ever written.
Cool. What's the most undervalued financial skill in startups today, or skill?
Generally, I would say it's probably selling. I think at the end of the day, so much of this business is a sales business. You're selling talent, you're selling people. A lot of folks definitely put a lot of emphasis on other things, pitching and so forth. But I think your ability to get someone across the line and believe in you is just something that, I probably didn't have enough appreciation for it early in my career.
Awesome. Rick, I so appreciate this. It's been amazing. So many good takeaways for our listeners. I can't wait to do it again. Thanks so much.
Looking forward to it, Jeff. Next time we'll tell all the high school stories.
Thanks for tuning in to 5 to 50. If you found today's episode helpful, be sure to subscribe, leave a review, and share with other business owners looking to grow. Do you have a question or a topic you'd like us to cover? Connect with us on LinkedIn or reach out to us at ProSeer, where we're empowering entrepreneurs with real-time, actionable insights and financial infrastructure through smarter accounting, tax, and financial strategies. Let's keep this conversation going. Together, we'll help our businesses thrive. Talk to you soon.